strengthened a little, but the currency's levels have intensified concerns about inflation here at home as a weak rand makes all our imports more expensive. South African miners, already warning of closures, are of course also heavily reliant on the Chinese market. So just how worried should we be? To find out, we're joined by Owen Nkomo from Nkunzi. Great to have you with us, Owen.
Thank you very much, Francis.
So, when I was in China, I remember a journalist come up to me and said the GDP growth came in at 10% that day. He believed it. It was actually 7%. So if their own journalists don't know what's going on, does anyone really know how big this problem is?
It's always been a number that was debated over the years, whether the GDP numbers we're getting out of China were realistic, when the numbers were 10%, 9, 8%. And now they're coming back, they're down at 7%. People are wondering, actually, is there that much growth happening in that country? With the country having a surplus of a whole lot of buildings and things like that are not occupied. People are wondering if the numbers are not being inflated. But then again, we will much rather err to the side of caution and say that we are hoping that the Chinese have been giving us the correct numbers. And I think the biggest concern for people at the moment is the fact that for the first time, it looks like the Chinese economy may come under a lot of pressure on a GDP perspective, with 7% being an important benchmark there, because that's where the Chinese government wants the Chinese economy to grow at. But the indicators that we're getting are to the extent that probably we will go below 7% in the next coming couple of months.
I read a piece and the author was saying that a crash of intense proportions is coming if you look at the debt of the local governments in China, because they owned the buildings, they developed them, lent them out, and then there was the property bubble burst. Is that overblown? Should we calm down because this has huge ramifications for South Africa?
See, I think in my view, if you look at China from the perspective of the municipalities, we know they've gone out, they've taken debt, and they've permitted the building of all of these, ghost towns, as we call them in the market. So one wonders where the rest of the growth is going to come from, because China has been an infrastructure growth driven GDP, cycle. The GDP has been growing in China because of our infrastructure, buildings and stuff like that, roads, dams, you name it. In the past 10 years. Now that is done, and we only starting to get the Chinese people to become consumers as opposed to savers, we're wondering where the drivers of growth in China are going to come from. That is where the big question is. We have been exporting things to China. Australia has been exporting things in China, Brazil, etc. But now, with all these buildings having been built and no one taking them up for economic use, profitably enough, is China going to consume more commodities from the rest of the world? That is a question. And really, I think there could be a big crash, in my view, in the municipality funding space in China. But China operates differently. China has got a lot of money, in my view, that the government is always willing to throw at the problems. We saw them intervene in the stock market, something which I actually don't think any government has done, taking its own finances and putting it into the stock market to try and stem the decline in the markets. So, all of those things kind of get me thinking China still has a lot of tools they could apply to the problem. But whether or not the tools are going to work is going to be a debate we will have to see.
And of course, that's also stemmed investor confidence, this blatant intervention by the Chinese government. What are the implications for South Africa? Say growth just slows down. Say real growth in China is about 5%.
Look, I mean, growth definitely already is slowing down. And I think by the time, if we should see the GDP readings in China go below 7%, I believe that we'll see more aggressive selling into the Chinese market and in global markets in general. Because it will be a confirmation that what China did by relinquishing the peg against the US dollar was partly in fear of the economy not doing well. So I believe that we could potentially, with more Chinese slowdown, we could see the global markets and economies start to slow down. South Africa, we've seen the impact of that with the currency weakening. And I think, the stories that we're starting to see in the press about miners closing down some shafts, that's going to become a reality for us.
Well, let's look at those miners, because the gold miners this week have been doing well. Investors hide in gold; it's a safe haven. But is that a temporary blip? Because what we're looking at is potentially dire for a lot of miners.
I promise you that I wouldn't buy into this gold rally. Gold is rallying because everyone is now going into an environment where they're saying they need safe assets, and gold is believed to be one of those safe assets. I personally believe that you should be buying gold in an environment where you're trying to defend against inflationary pressures. And at this stage, the world has absolutely no inflation. You know, the Eurozone is battling to get inflation higher. America is getting to push inflation anything above 1%, you know. So it's a big challenge in my view to say the gold sector has recovered and it's a good thing and you should be excited. I think it's just because the gold price instead has been trading better and these gold stocks have been aggressively sold off. We will see, you know, down the line some of these platinum stocks start to also get bought up. We saw Lonmin up today nicely and it was up yesterday as well. But they're now already at very low levels, you know, at multiple year lows. And one thing that I think is great in the market is the fact that the market has been very fast to discount a very slow economy in China. For that reason, we're seeing a Lonmin trading at $6, $7 at the moment. So is there further downside for a business that, you know, has got the right balance sheet? Is there further downside on the share price? I would like to think not.
Well, that's what I was going to ask you. Is Lonmin struggling to survive? And is China the factor that will determine how some of these miners do? I guess that's just what you basically said.
Yes. So Lonmin is a rather tough one because of their balance sheet is not the greatest in the mining space. If you were to compare them to, say, an Impala Platinum, or if you compare them to a Northam or a Royal Bafokeng in the mining space. So an Anglo-American Platinum, that is a big brother in Anglos. You know, I think Lonmin is fairly exposed, and I think the challenges that we've seen with the share price in that business are a reflection of the investors lacking confidence in the fact that Lonmin may be around for long if they don't get to restructure their debt properly, and if they don't get any further funding from shareholders. Lonmin has got a lot more shafts to close.
All right, so Lonmin is at risk. Just outline in finality, in coming days, weeks and months, what does this mean for South Africa? We do have inflation. Our rand is extremely weak. We import a lot of goods, so we're already under pressure. Is it going to get worse and worse?
Look, I mean, the one thing that could be a challenge, if China continues to weaken its currency against the US dollar, and therefore we see the rest of the world and emerging markets currencies continue to weaken against the euro, then we will have a rand that can weaken more significantly above 13. Then Mr. Kganyago is not going to have any choice but to increase interest rates in our view, because, you know, we're trying to make sure that we react fast enough and contain inflation, you know, from pushing higher. And I think definitely for us, the interest rate environment is going to get more unfavorable for the consumers out there.
All right, unfortunately. But thank you for your analysis, Owen Nkomo from Nkunzi. Let's look at another impact of what's